the Jenga tower is tall. It could get taller still. I'm not saying it's about to collapse, but whenever that tower has fewer supports, it just means it's more vulnerable to a shock. And that shock could come from AI not meeting expectations. It could come from the Fed disappointing expectations. It could come from wealthy consumers getting cautious about who knows what.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to this episode of The Bull of Wall Street. My name's Talley. I'm the Chief Market Strategist at the Wealth Consulting Group, and I'm joined by my friend and co-host Jim Worden, our CIO. And this time, our very special guest needs no introduction. Rebecca Patterson, Senior Fellow at the Council on Foreign Relations. Welcome to the show, Rebecca.
Thank you. It's good to be with you guys.
100%. And maybe we could start with some softball questions, like some of the things our advisor audience may not know about you. For example, is it true that you have an undergraduate degree in journalism?
Yep. That is right. I was born in St. Louis, but moved to Florida when I was about 2 months old. So I almost feel like I should be able to say I'm a Florida native. It seems darn close. But yeah, I grew up there. My dad worked at University of Florida, so I was born and raised a Gator. And initially thought I would be an astronaut, and I studied aeronautical engineering. And then around my junior year, I wanted to take a class that was going to be using a different part of my brain. And I took a writing class, and it was a light bulb moment. I said, okay, I need to be doing something different. Yep. So I switched, and I spent the first 8 years of my professional life as a journalist. Yep.
Wow.
Eureka moment. Well, judging by your performances, Rebecca, I think all of that uniquely positions you to interact with the media. And I don't know if you remember this, but we formally met for the first time. This was April 9th. So it was the day after the market bottomed in the green room of Charles Payne's Making Money show.
Yep. No, I remember that. I was a little surprised they didn't have makeup and hair ladies. The older I get, the more I like those women.
Well, they skipped the hair on me for obvious reasons, but I find green rooms are underappreciated networking venues, and here we are. I think this is great. But I wanted to kind of start in with some questions about the markets. Maybe we could play a little hardball here for a while. And as I described earlier, WCG has a diversity of thought culture. So we welcome opposing views because I think it, and Jim agrees, it really keeps us balanced. And if I remember correctly, you can correct me if I'm wrong, but you were cautious on stocks back then, which was understandable completely because of the extreme uncertainty related to the tariffs at the time. And I think you had to focus on defense and consumer staples. But ironically, that uncertainty was one of the 8 reasons I presented why I thought investors should buy the dips. And here we are. But what is your view now? A lot has happened since then. Are you bullish or bearish on stocks right here? I'd
say overall, I am bullish on equities going into 2026, but I continue to have a fairly cautious tone about everything I see. So I think even back in April, I agree. I was being cautious and saying that people needed to make sure they had diversification of their portfolios. I wasn't saying bail out of tech, but I certainly at that point wasn't saying add to your exposure.
Right.
I think if I have to say what surprised me this year, The
But
amount of CapEx coming from AI certainly has exceeded what I thought we'd see this year. I think just the top four companies were probably up to about 380 billion estimated spend on CapEx this year. It's just incredible.
Yep.
I think the consumer resilience now, it's almost all at the very wealthy consumer level, and they're benefiting from those equity gains and to a degree home price gains. And then the tariffs have been delayed and watered down more than I certainly feared back in early April. And that's good news. It's been less of a headwind for the economy than I think in early April, a lot of folks thought it might be. So things haven't been as bad as feared. I would say they also haven't been as good as they might have been
but
without some of the policy uncertainty, especially tariffs. And into next year, I sit there all the time and like you have diversity of thought, I will try to challenge myself and say, where am I wrong? Where am I wrong?
Right.
And the bull case, I think, is pretty straightforward. You've got an expectation from these companies that AI CapEx will be even greater next year. It's
Mhm.
early days, but we are starting to see dispersion of
but
AI in companies. And I think that will continue. It's a question if they meet expectations, but it will continue. At the margin, we're going to have some fiscal stimulus in the US and overseas. We should have some at least modest, more monetary stimulus. We should have large buybacks. So you can make a pretty strong bull case, I think, for next year. I guess where I get a little antsy, valuations are high, but we know they don't tell you what performance will be over the short term. So it's a data point, but that's it. I do
Mhm.
think the AI CapEx story is one that's getting a lot more attention as financing goes from just cash on balance sheet to debt. And that's getting some investors a little more nervous about how long can this play out unless we get some much stronger earnings growth and much greater dispersion of AI into companies to create those revenues. And then I worry about the labor market. Right now, the job cuts
Yep.
we're seeing uh, are modest. Federal government job cuts are pretty big. We're estimating about 300,000 this year. But beyond that, most of the job cuts we're seeing are with smaller companies and they're with sectors and industries that had really overhired immediately after the pandemic. What makes
and
me nervous is historically,
and
you easily see some momentum in layoffs and they can become self-fulfilling in a way where you get that hockey stick of jobless claims and layoffs. I'm not saying we will see that next year, but it's something I'm keeping an eye on alongside of business confidence and consumer confidence surveys.
Well,
and
to your credit, you were right about large caps and gold. So kudos to you. And we run like you. It sounds like a diversified kind of mix of models and portfolios for our clients, which I think you would appreciate given your time at Bessemer. But and I would agree. The U.S. economy, its resilience has surprised many observers. But you sent me an opinion column. I wanted to kind of circle back to in the New York Times because I'm actually not a subscriber, so I couldn't unlock it. But the title's got the attention. No worries. We're just try it out. We're good. This is, I think you call it, this is how our economy comes crashing down. And we want to know the downside risks because we're a little bit too bullish, if you will. So we want to know where our hidden biases and blind spots are. So maybe you could kind of give us the Cliff Notes version of that.
Sure, sure. So, one thing everyone here should know whenever you pick up pretty much any newspaper, the headlines are written by a completely different group than the actual articles. So, I have no control over my headlines.
Yourselves, right?
So, it tends to be a little clickbaity and sometimes a little more strongly worded than I mean. But the point is that if you look at consensus estimates for next year, US GDP growth holding in roughly the same as this year, earnings growth expectations or EPS growth expectations actually higher next year than this year. So the consensus already is looking for the world to be good. Pretty much, and that's what gets me nervous. If the Fed cuts and the EPS growth and the GDP growth are already priced in to be strong or even better next year, that's what makes me say, okay, what could make this wrong? And my argument was a little that the US is becoming like a Jenga tower. And the tower is getting taller, but it's maybe getting a little more wobbly. And the wobbly bits come from um, business. So large businesses are still holding up okay. Small businesses in America, which is 46% of employees and the vast majority of importing companies, they've gotten hit a lot harder by the tariffs. They're
Mhm.
expecting much sharper declines in revenue this year, and they're cutting jobs. So the Jenga tower, you've lost small businesses. On consumers, you've lost the low income consumer. They're having a much harder time with this affordability crisis than the wealthy, again, who benefited from the equity gains. And then I think in pretty much equities, you're losing. We talked about it a second ago. You've lost, not lost, but you're not having the participation of the small cap stocks. In fact, in equities, as we all know, and you talk about all the time on your podcast, it's really the top 10 or so companies, tech and a handful, small handful of financials that are driving the whole thing. So the Jenga tower is tall. It could get taller still. I'm not saying it's about to collapse, but whenever that tower has fewer supports, it just means it's more vulnerable to a shock. And that shock could come from AI not meeting expectations. It could come from the Fed disappointing expectations. It could come from wealthy consumers getting cautious about who knows what.
Well, well, Jim, jump in here.
Yeah, so I love everything what you're saying. It makes absolute perfect sense to me. And as I'm thinking about kind of where the Fed is at, inflation's still closer to 3% than 2%. But as you say, the labor market's a big concern. And that's been my primary concern is the labor market. What should the Fed do? Should they be more focused on inflation and kind of the people that are kind of at the bottom struggling a lot? Or should they be thinking, hey, labor market is, we really have to do something for the labor market and ease conditions? Where do you think? What do you think?
Yeah, I feel for the Fed at this coming meeting on December 10th because the September payroll number, which is the only payroll number we're going to get before the meeting, so it's dated, and it was strong. I mean, 119,000 jobs that month. So the data they have, it shows the labor market trending slower, but it doesn't show anything falling off a cliff that they need to react to urgently. Now they know that the Fed monetary policy changes takes a long time to feed through the economy, so they don't want to wait till they see a problem. But the labor market isn't a very clear signal. It is a signal, but it's not a very clear signal. And then inflation. President Trump has created some more loopholes in the tariffs to try to reduce inflation rates for food. I think that's great. It'll take a while for that to flow through. Wages are coming down slowly based on the data the Atlanta Fed and other measures have. House prices through rents coming down maybe slowly in certain parts of the country, at least.
Sure.
So inflation, it's a question if it's going to be sticky around 3 with the pushes and pulls, or if the things I just talked about are enough to get it down. So I think we will have dissents at the Fed. But if we hadn't had the inflation shock in 21, 22 that caused the Fed to have to raise rates so aggressively, I think they probably would be more comfortable cutting a bit more. I think at this point in time, because of that experience, they're more concerned, relatively speaking, with losing that inflation anchor, that credibility. And so I believe that the bias of risks is that we don't get the 3 to 4 cuts priced in by this time next year. I think it's possible we get 1 or 2 unless the labor market slows very sharply from here. And if that happens, stocks are probably coming down too because consumers want incomes to spend.
Sure.
Can
And what?
back on that?
Yeah, go ahead.
Well, so the broader question about financial conditions and bonds. So we've actually had a good amount of easing in those broader financial conditions. And I think it's another way of saying or explaining why the growth outlook is firming up here. But if you rewind the tape, yields, this is kind of another way of saying the same thing. Yields were higher back in April. I think the 10-year was closer to 4.5, and the 20-year was closer, I think, to 5. But what do you make? Because you just talked about all those inflation dynamics. What do you make of the buoyancy of bond prices here, despite those tariff related to inflation concerns. Is the bond market doing the Fed's job for it here?
A little, although again, financial conditions is more than the 10-year, 30-year bond yield, as you know. It's going to be stocks, it's going to be the dollar, et cetera. So I think financial conditions generally are quite easy, would argue against aggressive Fed cuts from here. That if the Fed were to cut much more, that you could actually fuel an already decent economy and create more inflation. They don't want to do that either. But the bond yield is helping us. I mean, I was looking at fixed 30-year mortgages earlier today, just ahead of the show. And from the start of the year till now, we have seen that mortgage rate come down a decent amount. Right. We were above 7. Now we're down to like 6.3, 6.4 for the 30-year mortgage. That's great news. The problem is we have so many Americans who locked in mortgages at something less than 4%. So they're still not feeling awesome about buying a new home at these rates. That you could act.
Sorry, I cut you off, Jim.
No, you're good. So I just kind of following up on, you mentioned the wealthy consumer, then there's the struggling consumer. We have demographic changes, the baby boomers and wealth transfer, all these things happening. And then immigration, right? That big changes there.
That you could act.
One of the things that I look at is kind of the labor force participation rate and the people that are not in the labor force. It looks like some of those people could come back, but maybe they don't. I mean, do you get any indication? Are some of these people going to come back into the labor force? That would certainly push the unemployment rate higher, but like, I don't know. I don't get a good read on that because it just seems like there's a lot of unknowns that could move it either way.
Yeah, no, I mean, absolutely. This is, I think, one of the most complex economic backdrops or even geoeconomic backdrops I've ever lived through in my career. AI is such a huge story driving the economy and financial markets. But as you just said, there's a lot of other pieces that are significant. AI is not the whole story. The Dallas Federal Reserve put out a research note this summer that I thought it was quite good. Looking to your point on the demographics, they were focusing on the outbound immigrants, so foreign workers leaving the country. And they estimated that if the current pace continues this year and next year, it could take off as much as 0.8 of a percentage point. So 80 basis points from GDP each this year and next year. That you could have a pretty big hit to the economy. And then to your other point, so if they're leaving, in theory, you should have a tighter labor market, and that should push up wages and attract some of these people who've been sitting on the sidelines to come back in. We're not seeing a lot of evidence of that yet. And then there's wrinkles there. So I was just reading yesterday that you could act. So the government trying to help farmers who've been hit with the tariffs are now saying, well, we're going to cut your costs. So even if you're not selling as many soybeans to China, your working costs are lower. So that kind of helps even things out. But the way they're doing that is lowering minimum wages for farm workers who come on temporary visas, thinking that they're mainly immigrants, but they're not. That you could actually, the majority of them are Americans. And so you're actually...
wow.
So if I'm on the sidelines and one of my options is to go work in the farming industry writ large, but they're not paying me less, that you could act, no, that math doesn't math.
It doesn't work out with supply demand and where you're going to work.
And I share this story only because, I'm not trying to overcomplicate it. God knows we don't want to make investing more difficult or complicated than it needs to be. But I do want to illustrate that all these policies have unintended consequences, wrinkles to them. So when someone say tariffs are good, tariffs are bad, look at the second and third derivative.
Yeah.
That's the headline.
That's interesting. There's a lot of domino effects. You can't just think about, one basic thing. Well, that makes me think about the auto parts, right? The auto parts that we bring in from Canada, and then it goes to Mexico and then comes back here, and just making a blanket statement about, hey, well, we want to put tariffs on. Well, that creates all kinds of unintended consequences.
So I'll share a quick story on that. So I was in Canada last month, with a group that I'm part of called the Trilateral Commission. And we had a number of Canada, American, Mexican policymakers, companies there, including in the auto sector. Now, I try to follow this pretty carefully, but I don't know everything, God knows. And I didn't appreciate that the tariffs are on the finished vehicle, not necessarily on the parts when it comes to the US Canada Mexico border. Most of those parts come under the USMCA, formerly NAFTA umbrella. They're tariff free. So moving those back and forth across the borders, that's fine. The problem is when you get to the finished good and if it doesn't meet all the USMCA requirements. So again, the headline can make things seem better or worse than the details suggest. But what I will say is the Canadians and Mexicans that I got to speak with, so the review of USMCA is next year. And if it's not renewed, it will sunset. I don't think that'll happen. But all these entities are trying to figure out what do we need to renegotiate? What do we need to give to hold this together? Because at the end of the day, those trade partners are our most important allies economically, nationally, militarily. It makes sense for us to continue to partner with them. If we think about rare earth metals, hello, Canada.
Yeah.
If we're thinking about small modular nuclear reactors, they're way ahead of America on that. So there's a lot of reasons that we want to make sure we stay friendly with these countries, and hopefully the tariffs with both sides will go down or at least not get worse, because it only hurts us when we do that. Quite frankly, we're not seeing a lot of those jobs move back. If you're an auto plant in Canada or a part plant in Canada, to move something across the border to the U.S., you're talking about billions of dollars in at least 5 years. Why would you do that when you don't even know what the policy will be in 3 years when we have a new government? Can you imagine if you put in that investment and 3 years from now, they're like, oh, never mind on the tariffs?
Yeah.
I mean, that you would get fired as CEO. So the changes that are being made by these companies are more incremental and marginal rather than wholesale at this point.
Interesting.
Well,
Super fascinating. Yeah, go ahead.
I have a sister who lives in Canada between Kingston and Toronto, and they were a little upset. I went back there to visit them in May, and they feel betrayed. They don't understand the aggression, and so to me, in my humble opinion, that was more broadly speaking what the tariff tantrum in April was really about. This concern that the administration could potentially kill the golden goose that is the American consumer with these tariffs, because they're a tax and a brake on growth. You got to go easy with the tariffs. But if you look, Rebecca, and I'm sure you know this, at the actual effective tariff rate, it's quite a bit lower than what was threatened. It's like 8 or 9% as a share of imports or however you want to measure it. But we'll see where it settles. But to me, it feels probably in the 10 to 15% range, maybe. I don't know how you feel about that.
Yeah, I mean, we're going to have some big news at some point, probably in the next month, maybe 2 months, in terms of the Supreme Court's decision on these reciprocal tariffs, right? The emergency powers tariffs. And that's
huge.
That's the 15% tariff on a lot of different countries and higher on some. And if they go away, I think the White House has a new set of tariffs it can put in place. It might not be the exact same mix on countries and industries, but they want to try to get to a similar overall level of tariffs to bring in the revenue, because that revenue, of course, helps us fund the budget deficit.
Yeah.
But it's going to be a lot of volatility if we get news that those tariffs are being overturned. And if they get held up, the one thing I think I want to make sure everyone listening here is aware of is if they get held, it opens the door for any executive now and in the future to also tax capital. Pretty much any. So it's not just about goods. We could be talking about capital taxes. And that's a whole different kettle of fish. And if you think the dollar's weak now and gold's high now, if that were to happen, I think you would see more diversification from foreign investors of U.S. assets and a weaker dollar. Because if you're going to tax money coming into the country, guess what's going to happen? Less money is going to come into the country.
Yeah. Wow.
The tariff decision by the Supreme Court, it doesn't mean that will happen, but it would give the executive branch that
Mm.
Well, let's
effectively.
go there. I'm glad you kind of took us, because that's a nice segue, because the dollar decline has paused for a time. So where do you think it goes from here? Does it weaken further because the Fed keeps cutting rates? And you're a policy expert, or do powerful, I mean, it could go either way, I guess. Do powerful inflows prop up the currency, or if we get some kind of negative ruling, it does what you just suggested?
Yeah, so I started my banking career in foreign exchange. So my last journalism job was writing the daily foreign exchange column for the Wall Street Journal. And then I moved over to JP Morgan in 1997, where I started there in their investment bank doing currency and commodity research. So I've been a currency girl my entire life. I love currency markets. Uh, the dollar right now is so interesting to me because it's changed its character a bit. Back in certainly in April, but even through the summer, I think the focus was primarily on diversification. Our foreign investors looking at their US exposure, stocks, bonds, currencies, saying, maybe it's a little too much, let's pull back.
Hmm.
That story now has become more focused on fiscal dynamics. And I almost call them the fragile four. You've got France, US, UK, Japan. So we all have large and rising budget deficits. We all have debt GDP outlooks that aren't great, rising interest payment costs. And I mean, in France's case, they've had what, 3, 4 prime ministers in the last year
Mm.
because of fiscal decisions. So the reason the dollar has stabilized recently, in my opinion, is less about the Fed or the US economy being great. It's more with who's the ugliest house on the block. And Japan is definitely winning the ugly beauty contest right now. The yen has given back all of its gains against the dollar this year. It's now flat against the dollar year to date. And that's because the new prime minister there, Takaichi, was elected to help address the affordability crisis. So she's doing more fiscal stimulus, the biggest stimulus they've had since the pandemic, to help households dealing with inflation. So she's going to give out checks. She's going to do subsidies. And that pushes up their debt even further and gets investors nervous that bond yields are going up and the yen is going to get weaker. People are getting nervous about those assets. But France, the UK, the US, we're all in a similar version. It's just that right now, the Europe worries, France in particular, and the Japanese worries have led to some profit taking on those currencies. And that's because currencies are always pairs. If they go down enough and they're big liquid currencies, it actually makes the dollar look a little better. But
Interesting.
next year, I think the dollar's probably still headed modestly lower, partly Fed cuts, even if they're modest. And partly, I think the diversification out of US assets is a slow grind. It's not a one and done. So I do think there's a risk we could see modest further dollar weakness next year.
Do you think that gold prices will continue to perform how they've done, or and it's weird because we've seen Bitcoin and gold for a while, not recently, but for a while they've kind of moved together, which is odd.
Yes. I think gold is still biased higher. The big move we had recently, I think, started to get much more of a retail flavor and more of a speculative flavor. And I don't know if that'll continue. I have no idea, frankly. But what I think will continue is this underpinning of central bank diversification. So central bank buying of gold has been pretty steady for the last few years, mainly from emerging economies, but not only. And they can add a lot more. If you look at the amount of gold they have in reserves compared to their total reserves or compared to developed central banks, they could add a lot more, including China. So
Interesting.
I think that demand lasts. If the dollar weakens, that'll be a help as well. And it's just a nice hedge against those tail risks. I mean, we have Russian, I think, drones flying in Europe right now. We have a potential hot war near Venezuela. We have worries over Taiwan resurfacing again. So I like having some hedges in my portfolio, and gold seems like a pretty safe bet to me, even at these levels.
Yeah, interesting.
Well, I hope you're right about the currency, because that would support a risk on posture and be good for stocks through top line foreign revenue exposure. But I'll play devil's advocate. So I bought, and this isn't my view, but we'll just play around with it. So I bought the eighth edition of Kindleberger's Manias, Panics, and Crashes, MPC, and this thing is a living manuscript. So this one has three authors, and I think it was out in 2023. But it's based on the original version back in 1978, I think it was. But this guy, I mean, he's nuts. He's no longer with us, but he wrote like 30 books. It's crazy. Charlie Kindleberger, MIT. But so if we're right that this is kind of tech mania 2.0, and we're in the displacement phase. So basically, I'll take a step back. So Kindleberger famously took Hyman Minsky's, I think he had a 5-step or so framework or something like that, and applied it to actual events in history, and it works. It's pretty impressive. And so that's why I read the current one, just to kind of get myself up to speed with what's going on. But the way that would evolve in that framework, we would have massive capital inflow. And we've actually started to see that from Korean and Taiwanese investors in US mega cap tech stocks. So that would actually prop up the currency. And then you would see borrowing on credit, people buying and investing in stocks on margin, I guess. And we had seen some of that. And so that would be the kind of the beginning of the end of that downward spiral. What do you think of that? How far away from that? Is that a realistic scenario?
So I think the only pushback I'd give you is, what if they hedge? So if I'm South Korea or I'm Taiwan or whoever, and I'm like, you know what, I need to have some of that US mega cap tech exposure, because they might get to super intelligence. They may crack the code, and I want to be there for that hockey stick moment when their stocks double in value. So could we see more foreign investors continuing to want to put money in the US? Sure. But if they're looking at the policy volatility that they're experiencing, and you mentioned friends and relatives in Canada, that feeling in Canada is shared generally overseas right now. Not necessarily anger, but just confusion and a high degree of uncertainty. And when you have a high degree of uncertainty and your portfolio is 70 or plus % US denominated, so I think you say, okay, I want the stocks for good structural reasons, but I'm going to hedge out that currency. And that's part of what we've seen this year. You know, the disparity between the stock performance and the currency performance is quite large this year versus past years. I think part of that is dollar hedging. And I think that could easily continue. The margin buying that you're talking about, yeah, that wouldn't surprise me. Although I don't know what you all think. Can I ask you a question? So
Yeah.
Is the Bitcoin sell-off, is the liquidation of those positions, especially investors who maybe had leverage, do you think that's meaningful enough to actually cause them to take profit on their tech and other stock holdings to cover their losses? Do you think there's actual contagion between those markets? It's something I'm wrestling with. So
that's a good question. I mean, I'll take a stab at it. I think there does seem to be periods where there are correlations between, Mag 7 and Bitcoin, but like, I don't know how strong that correlation is. We know that there are pockets of froth, I believe, and there's some retail speculation, I think, going on. But I don't know how much of an impact that is, because I feel like there's still, institutional investors have largely been on the sidelines through some of this bull market. And so to the degree that they see that there's still growth and, certain areas within technology, that they could still invest there. But like with the Bitcoin, and then there's the whole discussion about tokenization and the long-term buyers of Bitcoin. Right. For us, we're fairly agnostic. We have models that have a little bit of gold in Bitcoin, And I own some, and I like it from a long-term standpoint, but like this is something we certainly don't want to own more than a couple percent in a portfolio. That's at least that's my view. Tally, I don't know what your thought is on it.
Well, so I've seen charts and I've looked at the relationship myself. So as you know this, but there is a direct relationship between the Nasdaq and Bitcoin. They move together. They're not inverse. They're not selling out of one to buy into another. So, and you know, we debate this all the time, Jim. We've been on panels with angry CIOs that complain that Bitcoin doesn't fit into the Markowitz risk return space and all this theoretical stuff, which is true, you know. But it's like, well, it's a much more volatile version of the Nasdaq. I would say, you know, having talked to guys like Matt Hogan at Bitwise, who's a digital asset expert, this is probably one of those hodl moments with, you know, the die-hard believers in Bitcoin are probably buying the dips on this pullback, if I had to guess, Rebecca.
Well, and you know what? So Rebecca, we had Kathy Wood on last week, and so
that was a great conversation.
Yeah, so she makes the case that, hey, look, there's going to be a lot more in blockchain, and we like Bitcoin, but she's also liking tech. So like fundamentally, I do see, that there is certainly a correlation there.
Yeah.
I'll confess, I actually did try to buy IBIT back in April, second week of April. But I have a Citi IRA and they rejected it, so I just bought the Nasdaq. Kind of what we're saying, right? Because I knew the relationship. Ironically, a less risky play on some of the same animal spirits.
So Rebecca, I've got a question for you. So you spent some time with Bridgewater, and you said you're a currency girl. You know, and a lot of what they're doing is macro. That's really more of Talley's wheelhouse. But for me, I'm just curious, like, when you have a macro framework that you're looking at in terms of whether it's currencies and commodities and flows, and there's, you know, so I'm kind of a technician. I look at technicals and trends and things like that. But how does that framework change over time as it relates to cycles? And, you know, I know Ray Dalio talks about debt cycles and things like that. What is your take on like, how does this thing change, or should it remain fairly static over time, or does a framework need to be adjusted?
Yeah, I mean, it's a great question. So I'll talk for myself rather than Bridgewater right now, but I think so generally the cause effect relationships, right? If the job market gets soft, consumers have less money, they spend less, that affects earnings. That would be an example of those cause-effect relationships.
Sure.
Those things don't change.
Mm-hmm.
I have a job, I'm more likely to spend. That doesn't change. So some things don't change over time. When countries build up debt, at a certain point, makes them more vulnerable.
It's too much, yeah.
When valuations rise a lot, while it doesn't necessarily affect the short term or the long term, it's harder for those companies to meet those valuation expectations with earnings. So you tend to get over a 5-10 year period, lower returns. So there's some things that honestly just don't change over time. However, there's lots of things that do, of course, right? 5-10 years ago, we didn't have the same, we didn't have maybe any 10 years ago, same day options, levered options. We didn't have the same degree of influence of passive investing on the market. We didn't have the same influence of Bitcoin. We didn't have the same influence of private equity or credit. So when you're thinking about global macro, you absolutely do have models in your head for those cause and effect.
Mm-hmm.
You always have to be saying, what manifestations of that have I not captured that I need to now add to my model? So if I'm looking at flows, for example, today it becomes really important to capture retail flows. There are some things that are universal and timeless, and then there are other things that your model and thinking doesn't change, but the inputs to your model may get added to over time as the world changes. Does that make sense?
Yeah, no, that makes sense. I'm just thinking about like all the stuff with AI and like the demographic changes, and we go from being a very globalized world to deglobalize it. So I guess, yeah, you're going to look at those things where the changes are and
So
tweaking. Maybe the model weights get tweaked, but yeah, that's interesting.
I mean, GDP growth over the long term, so I'm talking 15, 20 years, is the single best predictor of equity markets in a country. Now, so we know they diverge. There's lots of things that influence them. AQR did an amazing paper about this maybe a decade ago. I still find it like a seminal paper on this topic. So if I'm thinking, what is GDP going to be over the next decade? I'm going to look at two things, labor and productivity. How many workers do I have in the output? So with labor, I'm thinking about demographics and how many babies are going to be born, how many immigrants are we going to have. I can forecast those things. They don't change that fast. And then something like AI, then you have to start making scenarios because no one knows. No one. So we can say, all right, we have the bullish AI productivity boom, life is beautiful case. So maybe the AI incremental productivity, it's helpful, certainly, but maybe not life-changing. And then so
extinction level event.
Exactly. PDO.
I know what you're talking about.
Yes.
So Terminator scenario, right?
So, but you can use those things.
Are we laughing?
And start, I know we shouldn't be laughing. And it's nervous laughter, Talley. Very nervous laughter. But you can start modeling those things out. So even very long term and they're sort of behind the scenes, they're still meaningful and important to capture in a model. Shorter term, like over a 1 year period, personally, I start really top down. So I think, what is liquidity going to do on a global basis next year? Which central banks are cutting? Where could we see QE? So high level liquidity. Where are we going to see global fiscal easing? So I start with the global picture. What's the breadth of growth? How many countries are seeing expanding growth versus contracting growth or slowing growth? So you do the global picture, and the global picture helps you understand whether emerging markets are going to do well. It's going to help you understand commodity demand and supply. And then you go down into a country level. Then you can get down to a sector level. Then you can get down into a currency level. But I always look at technicals. I always look bottom up as well, because I find the most successful investments or trades come when all of those things come together. So,
absolutely. Well, and this is why Talley and I, when we agree on something, we usually say, well, there's something there, right? And macro technicals, and we look at the fundamentals, and we get all three of those. Absolutely. Then that usually works out better. So I wanted to follow up before I forget, the whole idea of changing leadership within, like the global framework. And this is it, going a little bit back to Talley. I think some of the stuff I read, it says, well, the U.S. has had its turn and China's next. And, we go through these periods. What are your thoughts on that? I mean, you can speak freely. You're no longer there, but I'm just curious what you think.
Yeah, I mean, one of the great things about Bridgewater is we all were encouraged to speak freely. And we would have some really incredible debates, sometimes very heated
I
debates,
bet.
but incredible, like thoughtful, well-articulated debates.
Yeah.
So I wrote a piece for the New York Times at the beginning of this year, and just saying that America needs to be careful that it stays exceptional. I think the United States economy, country, markets are exceptional. So I don't think we should ever take that for granted. And if we lose too many of our foreign workers, that's going to be something that nibbles away at exceptionalism. If we cut funding for research and development at universities too much, if we don't encourage more PhD students who get patents and can go into these startups and create all this innovation, that can nibble away at our exceptionalism.
Interesting.
I don't think it's a given that America goes into second place. But I don't think we should take it for granted. The AI race is a great example of that. I make sure to read the South China Morning Post and as much research as I can from Chinese authors as frequently as I can. And if I can, go to Asia. So you get a different perspective of what's going on out there. And it's a good reminder that, we've got some incredible technological talent and critical mass here. We have the ability to raise capital to fund these insanely large companies, but they've got more PhD STEM graduates than we do by multiples. They have more data than we do. They have a lot of good things going too in terms of technology. So and technology will help them win the race too, because demographics, they're done, right? Their population is starting to shrink, and they're not bringing in foreign workers. So if they're going to quote unquote win the global GDP race, it's got to be through tech, which is why they're doubling down on it in their latest 5-year plan. So
that's fascinating.
It's awesome. So put a bow on it for us, Rebecca. Looking ahead, what are the 3 or so big themes? It could be macro, it could be micro, that you think will dominate markets over the next decade?
Decade. Oof. All right. So the first thing, anyone who gives
Easy
you
question.
a decade out forecast, just kind of walk away quietly. They're educated guesses, right? They're usually built on models that focus on what happened historically. So they don't take into account inflection points, and AI could be one. We don't know.
Sure.
But I will say the things I'm focused on mainly over the next decade: technology, demographics / labor markets, and, well, geopolitics and climate. I'm giving you 4. So, and I'm throwing climate in there, even though it's become less exciting to talk about recently, because climate is driving labor. Climate is driving a lot of things. So if I live near the equator, there's a greater chance it's no longer habitable. And that's creating social and political events. And meanwhile, I have this technology. I look at my phone and say, oh, here's this TikTok or Instagram that tells me how to cross the border to get here. And here's the better life I can have here. Look, I can see it. And so if climate isn't tackled, either mitigation or adaptation, you're going to have more people leaving certain countries looking for better lives for themselves and their families, so that immigration crisis doesn't go away. Honestly, we need immigrants, but we need to figure out a better way to process them and assimilate them. Obviously, that's become very clear in the last couple of years. But immigration, demographics, climate, labor broadly, and tech, those would be the 4 biggies. Geopolitics, they're all tied together, Talley. Like, it's all part of one big bow.
And imagine if, not to complicate the message, but imagine if we get space exploration and other planets are colonized. Man, that would really screw up the demographic puzzle, I guess.
You really have to change the model on that one.
Well, that's we have a whole different conversation at that point.
Well, so this has been great. Is there anything that we didn't cover that you would like to kind of help us land the plane with here?
I mean, I think in terms of markets, I'll end with where I started. To me, there are some structural trends underway that you want to have exposure to in a portfolio. And that includes tech, that includes global defense, it includes infrastructure. Those things are going to keep going. It doesn't mean we won't have corrections. We probably will. I don't know when, I don't know how bad. So you want to have some diversification of portfolio, and that might be other countries that are more defensive, maybe lower valued, like the UK or Switzerland. I get nervous about having diversification through places like South Korea and Taiwan now, because it's more of the same tech trade. But you want to have a little bit of gold. You want to have some fixed income. So diversify the portfolio, stay with the long-term trends, and know that if the correction does come next year, if the Jenga tower topples, it doesn't stay down forever. We'll get a policy response. We'll get better valuations. We'll climb back up to the top. And so the goal is, don't panic when the Jenga tower falls. Just stay with your plan, which is what I know you all try to help people do.
Jen, you got the last word.
Well, I just had one last question, Rebecca. So, there's a new mayor in New York City, and you're out there. You probably know where I'm going with this, but we had on another person with Goldman Sachs several weeks back, and talked about kind of like this big gap between the well-off and those people that are really having a hard time. And this person, he was more moderate. I'm not going to say where they were politically, but they were just saying, well, we have to do something. Something has to give. And I don't know what the answer is. I don't know if it's universal basic income or more subsidies. I don't know what can happen or whether this just over time corrects itself. But I'm thinking of home ownership for new families, new households. What do you make of this in terms of like what's the solution?
I mean, getting prices to actually go down requires a recession, and I don't think anyone is advocating that as a solution.
Yeah.
So to slow inflation would be great. And I do think the White House, by backing off some of these tariffs and looking at other things they can do to lower prescription drug prices, et cetera, helpful. Housing, we need more supply.
Mm-hmm.
That takes time. So a lot of the solutions to this are complicated and take time. And in the meantime, I think we have to make sure people are educated and have the skills they need to find jobs. And to invest and take care of themselves. So one of my side gigs, my side hustles, I chair the board of a nonprofit called the Council for Economic Education. And we train teachers around the country to teach personal finance and economics to students. And we work directly with students. And I
that's
feel
wonderful.
Incredibly strongly that part of our problem today is people don't know how to save. They don't know how to invest. They don't know what a credit score is. And so it's only a small piece, but part of the affordability problem is that some people are taught from their parents or whomever how to invest and save and take advantage of those equity markets. And others think a savings account is good enough, and it's not. So I think education is a big part of how we fix this. I don't know if that's a priority for Mandami or not. I wish them all the best. I want New York City to thrive, and honestly, the whole country should too, because it's a big chunk of the economy.
Sure.
So
what a great inspirational way to end the podcast, and so easy to fill an hour with Rebecca Patterson. Thanks for coming on.
Oh, it's been an absolute pleasure. Thanks for having me.
Hers and his, three's company too. Come and dance on our floor.